And what I would
Yeah.
say is that this cycle hasn't reached anywhere near the levels of euphoria based on that metric or similar metrics than the prior major like multi-year cycle tops. But for example, in like say March 2024, it reached like a moderate level, and we did get like a 7-month consolidation, and then it reached kind of similar levels back in say November 2024 when it broke out and kind of touched 100K for the first time. So certainly these like mid-level euphoria periods could give us
Yeah.
6, 12 months of consolidation. I would just classify that a little bit different than what we've seen in like major tops.
Forget everything you thought you knew about Bitcoin's 4-year cycle. That old narrative is dead, and Bitcoin's next move is going to leave you speechless. For years, investors have clung to the idea that Bitcoin follows a rigid cycle tied to halvings. But guess what? That's a lie. As Bitcoin becomes more ingrained in the financial system, its market behavior is shifting in ways no one predicted. Sure, Bitcoin has experienced euphoric rises, brutal consolidations, and jaw-dropping breakouts, but it doesn't follow any simple pattern. Lyn Alden, the financial genius, is now blowing the doors off this outdated theory, revealing that Bitcoin's market cap, relative to its realized cap, is the real secret to understanding market sentiment. When the market cap skyrockets too fast, it's a sign of utter euphoria, and that's when corrections hit hard. But here's the shocker. Bitcoin hasn't even come close to hitting the insane levels of previous cycles. This time, things are unfolding completely differently. With moments of consolidation that could last months, Bitcoin's next move might just surprise us all. Forget the past. This cycle is rewriting the rules, and it's going to be unlike anything you've ever seen. Let's watch clips from Lyn Alden's explosive interview to gain more insight. Don't forget to like, subscribe, and enable notifications for additional in-depth content. Thanks for joining us again. Enjoy the video.
Like pre 2020, the correlation between Bitcoin and equities was lower. Then it became higher. Now, a lot of that happened because liquidity became a much bigger factor. So when we're doing like major fiscals and monetary liquidity bazookas, the
Yeah.
correlation of a lot of things goes up. And so that's kind of been like an artifact of that. But then certainly, yes, of course, once we get the spot Bitcoin ETFs that we had, and then now we get these other aspects going on, more integration between Bitcoin and the financial system. That can certainly increase correlation. We also, I partnered with Sam Callahan, and we released a research report on the correlation between Bitcoin and liquidity. And we also compared other asset classes to liquidity. And at least the way we measured liquidity, Bitcoin had the highest correlation with liquidity compared to stocks, compared to gold, compared to bonds. And I think there's a couple of reasons for that. One is it's so risk-on assets generally have higher positive correlation with liquidity. So that's stocks, for example, whereas
Yeah.
gold's more mixed because sometimes it's risk on, sometimes it's risk off, but it's got a little bit of a different dynamic there. It's not a pure risk on asset. Bitcoin's interesting because like gold, it doesn't have earnings, but like equities, it's still treated like a risk on asset. And so in some ways, it's a more pure liquidity barometer or
Sure.
liquidity correlate than any other asset class of similar size. Um, and so that's my general view is that it's probably going to continue to be pretty heavily correlated with liquidity, with the exception of major headline risks. So the United States buys 500,000 coins. I mean, that's going to override liquidity for a period of time, kind of like how the election was really positive for price for a number of months, even though liquidity was not really great. Because when you have a major like administration change and major favorable shift toward Bitcoin, that can override that liquidity correlation for a period of time. So in general, I expect it to continue to be pretty correlated with liquidity as a base case. So someone has a view on liquidity over, say, a 6 or 12 month period. Bitcoin is potentially one of the ways to express it. And then
Right.
there's other kind of industry specific variables that you can go to. Like a lot of my research kind of focuses on that because I'm kind of tied into that space. Um, and so yeah, I think there's be more and more kind of integration in that sense. In addition, it's one of the it's like the most liquid asset on like a weekend or one of it trades 24/7. So a lot of times people use it as like a weekend sell signal if they want to de-risk their portfolios due to something over the weekend. I think cycles are probably going to look a little different. I think people assume that like the 4-year cycle is like, built into law. I think as Bitcoin integrates more with the system and becomes larger, I think those cycles could change in structure. Um, and it's certainly the case that it could peak for a year or so, but that might be different than peaking for like a 2 to 3 year period. Um, and this goes back to the other metrics I look at. Like, for example, there are on-chain indicators and other metrics of
Yeah.
euphoria that you can kind of measure in the Bitcoin space. And one of my favorites is market cap compared to realized cap. And realized cap is basically just on-chain average cost basis. So, like, what is the price of the network? Except instead of using the current Bitcoin price for every coin, you look at every coin at the and price it the last time it moved, which is generally a lot of that volume is when people send it to exchanges or brought it from exchanges, which is a pretty psychologically important price level. And the point of all that rambling is that
Yeah.
when you have a big disconnect where market capitalization shot up way faster than cost basis, you're more at risk. It's a sign of euphoria, and the prices that we're seeing might not be, say, quote unquote, real because they haven't really been like liquid and realized for a long enough period of time. And what I would
Yeah.
say is that this cycle hasn't reached anywhere near the levels of euphoria based on that metric or similar metrics than the prior major like multi-year cycle tops. But for example, in like say March 2024, it reached like a moderate level, and we did get like a 7 month consolidation, and then it reached kind of similar levels back in say November 2024 when it broke out and kind of touched 100K for the first time. So certainly these like mid-level euphoria periods could give us
Yeah.
6, 12 months of consolidation. I would just classify that a little bit different than what we've seen in like major tops. Like last year, the Fed released a report, um, like their annual report, and they were kind of forecasting what they might do with their balance sheet. And they kind of eventually saw that they're probably going to bottom in their treasury holdings and eventually start going up. Whereas they plan to continue to divest from their mortgage-backed securities over time through maturation. Um, and so that's like a market pressure that, I mean, if markets are very forward looking, that's certainly one really big entity that they're kind of paying attention to and say, well, maybe it makes sense to have a bigger spread between MBS and treasuries if the
Yeah.
Fed's going to start treating MBS and treasuries significantly different. And of course, there are many other factors involved, but um, it's I don't really view like catastrophic mortgage risk in that market. I don't really view as like super risky, but I do think it's an interesting spread, and that's probably my best guess, or at least as a contributing variable for why that might be. One of the benefits of Bitcoin, like gold, is you can self-custody it. So instead of having like an entity hold it for you, you can self-custody it. Um, and what kind of security or hardware device you should have, or how many, would really depend on how many Bitcoins you're storing. If someone's holding $1 million worth of Bitcoin or $10 million worth of Bitcoin, that's different than someone who has $2,000 of Bitcoin kind of tucked away in a sock drawer, right? So there's a difference of variable. There's like some cheaper methods, like say tap signers. These are like NFC cards. They cost maybe, I don't know, off the top of my head, $20, $30. And they're like really great for kind of lower amounts of Bitcoin. And then as you get kind of higher, uh, some devices are 100 or $200, and those are kind of suitable for holding more substantial amounts
Yeah.
of Bitcoin.
Bitcoin's relationship with equities has flipped upside down thanks to liquidity. Spot Bitcoin ETFs and deeper market integration have transformed it into a lightning-fast liquidity barometer, outpacing stocks and gold. Traditional 4-year cycles? Toss them out. Bitcoin's flexibility is mind-blowing. Whether you're holding millions or just a few coins, Bitcoin's self-custody makes it the ultimate game changer. As central banks juggle liquidity and inflation, we see more than just interest rates coming into play. Fiscal deficits are becoming the real market movers, with central banks stepping in to stabilize shaky treasury markets. Bitcoin's role is growing, not just as digital gold, but as a powerful disruptor in the hard money world, challenging even silver and platinum. With these shifts, it's clear. Bitcoin is carving out a new path for itself in the financial landscape. Let's watch more clips from the interview.
So when there's high inflation, central banks generally want to get tighter. But if you have a dislocation in the treasury market, if you hit the liquidity floor in like bank reserves and you start to get really messy quarter end stuff every time, central banks kind of have to step in, and that's kind of part of their kind of informal mandate. Um, we see there's kind of two ways you can look at this. So one is in developed countries. Back in the last time we kind of had this kind of fiscal dominant environment was all the way back in like the 1940s, and you had very high inflation associated with the war, and you had central banks saying, "Look, it's the war. We gotta look pro liquidity into high inflation to support it." Um, and then a less extreme example is just like in developing countries around the world, they'll have above target inflation, and the central bank is still basically monetizing government deficits. Now that's why those currencies are often less attractive, but you generally see less extreme versions of that in um, uh, developed countries at times when you have very large fiscal issues and other things. Like I don't think that like if you have a dislocation in the treasury market, fiscal deficits are high, you're not going to get emergency cuts to Social Security, Medicare, or defense to the tune of hundreds of billions of dollars before you're going to get the Fed say, hey, for technical
Yeah.
ample reserve reasons, we're going to go to a neutral balance sheet approach, or we're going to go to we're going to get back to normal of like, keeping balance sheet growth in line with GDP growth. I think they're not like high inflation means that they generally can't say, hey, we're going to stimulate by doing a lot of excess QE to promote growth. But it doesn't really prevent them, at least the way they kind of, I think, look at it or kind of have to look at it, is to say, well, we're going to keep the wheels on the cart uh, with like liquidity and market functioning, not stocks per se, but like repo, treasuries markets, those kind of core markets. They keep the wheels on those kind of regardless of what we see on the CPI print. And
Right.
on average, I kind of had the view that maybe rates are less important than liquidity as far as kind of asset pricing and things like that. So in this kind of era of fiscal dominance, 50 basis points or 100 basis points in either direction is less interesting to me than what the balance sheet of the Fed is doing and what the size of the fiscal deficits are doing. So if they cut 500 billion off the deficit every single year, that's a massive impact versus the Fed changing interest rates by even 150 basis points or more. So I think, and most of the central bank's tools are based around promoting or suppressing bank lending because, for example, the 1970s inflation that was famously put out by Paul Volcker and other things. One was geopolitically get oil prices under control and oil flowing around. That was kind of
Right.
the non-financial thing, and then the financial aspect was there's very big demographics. So the baby boomers were kind of entering their home buying years, and you had higher than average bank lending. So higher than average money creation from bank lending. And high interest rates often suppress that. It's an effective tool. It's a tool for doing that. The problem in the current environment is that if bank lending is not very high, it's not no one. It's not like bank lending is booming. That's not really the source of inflation, and yet most of the Fed's tools are around either promoting more bank lending if say they view things as sluggish or trying to suppress bank lending if they view things as hot. But if bank lending is only like the second variable versus fiscal deficits, it kind of means the whole central bank is sort of playing second fiddle in that fiscal dominance environment, unless again we go back to the my non-base case, but that some questions could come up unless they do manage to say meaningfully cut the fiscal deficit on a sustained basis. I do. So a lot of people like to compare Bitcoin to gold, right? It's like, hey, Bitcoin's going to eat into the gold market. We had the prior question, hey, is America going to sell gold and buy Bitcoin? I think the more interesting question is does Bitcoin eat into the silver market and the platinum market? Um, and that's because if someone is a hard money enthusiast, a precious metals enthusiast, they go to gold if they generally want stability. And also, there's very large buyers of gold, central banks that are often not buying the others. So it's a certain market. People that like that hard money or precious metal. They want like monetary metals, even though those are both industrial and monetary metals, but at least the monetary component, they generally want higher volatility. So they're bullish on precious metals, and they'd rather have say the miners or silver or platinum. And the challenge there is that when you have Bitcoin and crypto, it plays to kind of the same crowd with that similar
Yeah.
level of volatility. So Bitcoin is, I think, when you're looking at a portfolio and you say, well, between Bitcoin and silver, which one do I want to own? Or Bitcoin and platinum, which one do I own? Or Bitcoin and gold miners? It's not really per se. Bitcoin is gold, at least in my view. So I do think that's been a non-trivial. When you're looking at like a $2 trillion market cap Bitcoin, versus these are, Bitcoin like briefly surpassed the estimated market cap of like silver.
Yeah.
So these are these are like comparable market sizes, and they do at least on the monetary portfolio side they somewhat compete. And I think that's a somewhat permanent state of being now. Like that's like a new thing that just is like a new part of the market, kind of like how shale is a new part of global equity market. So um, I think that's an ongoing disruption. But I do think if we get a major inflationary cycle, I'd be bullish on silver and platinum.
Bitcoin has long been regarded as digital gold, a scarce asset with a fixed supply as a hedge against inflation. However, recent trends suggest Ethereum might suddenly challenge Bitcoin's dominance through supply control. Unlike Bitcoin's rigid 21 million cap, Ethereum has adopted a more flexible model, allowing its supply to expand or contract based on network activity. Since the merge in 2022, Ethereum's issuance has slowed, and its total supply has sometimes decreased. This adaptability has led some to question whether Ethereum is outpacing Bitcoin to become the most sound form of money. Lyn Alden has long emphasized that Bitcoin's strict scarcity model gives it a unique advantage as a store of value. However, she also acknowledges that monetary systems are not one-size-fits-all. Historically, rigid monetary policies, such as the gold standard, have sometimes been a double-edged sword, offering stability but limiting economic flexibility during downturns. Ethereum's ability to dynamically adjust its supply introduces a middle ground approach, positioning itself as an asset that balances scarcity with adaptability. While Bitcoin remains the more established hard money, Ethereum's economic model is proving to be a worthy alternative, particularly in shifting market dynamics. Trump's recent announcement of a crypto strategic reserve that includes Bitcoin and Ethereum further highlights the ongoing debate. Both assets cement their roles in the evolving financial landscape as institutional interest grows. The question isn't just whether Bitcoin or Ethereum is superior, it's how their differing approaches to monetary policy will shape the future of digital assets. As we wrap up, do you think Bitcoin's 4-year halving cycle is still a reliable indicator of market trends? Let us know your thoughts in the comments below. Share this video and hit the like button. Thanks for watching, and don't forget to like and subscribe.